Hello, and welcome to the first video of our Institutional Investor series. In this video, we'll discuss how to think about asset allocation based on your organization's time horizon, values, and spending policy. The combination of these three critical factors will drive both the financial performance and your mission's impact. Let's get started. Asset allocation is the most important decision you will make as a committee. As a reminder, asset allocation involves diversifying your investments across various asset classes such as stocks, bonds, real estate, and cash equivalents. Diversification is fundamental to managing portfolio risk and achieving long-term financial goals. It's important to understand the differences between institutional and individual asset allocation. The allocations are both directly related to the investment time horizon. However, while individuals typically plan for a finite time horizon, such as retirement, institutions like nonprofits and endowments often have a perpetual time horizon. This means their investment strategies must be designed to support the organization's mission indefinitely. As a result, institutional asset allocation tends to be more focused on sustainability and long-term growth, taking into account factors like intergenerational equity and the need to balance current spending with preserving capital for future needs. This approach is a contrast to an individual's time horizon that shortens as the years pass and has to reduce their exposure to riskier, higher returning assets. As you may recall in our Investment Essentials series, the allocation between bonds, stocks, and alternative asset classes will generally become more conservative as the time horizon shortens, and vice versa. The longer the investment time horizon, the more we can allocate to equities, which generally produce higher returns over the long term. As such, an institution's asset allocation will stay relatively consistent, yet adapt over time so that it can continue to support its spending policy and changes in long-term goals and liquidity needs. It's important to keep in mind that while organizations generally have a goal of operating in perpetuity, the spending policy and liquidity needs will vary widely for each organization. Liquidity helps to ensure that the organization has the necessary funds to cover short-term financial commitments, such as grant-making obligations and operating expenses. Importantly, managing liquidity appropriately is critical in ensuring the organization isn't in a situation where it has to sell investments at an inopportune time. It must allocate a certain percentage of funds to liquid and less risky assets, such as treasury bonds, to cover the expected short-term cash outflows. The rest of the assets, however, can be allocated to higher returning assets, such as equities, or less liquid options, such as alternative investments, to sustain or grow the portfolio's value over time. Recall that while equities are typically higher returning assets over the long term, they also fluctuate constantly, and in almost every year we see a correction. In other words, a 10% decline within the year. Fortunately, despite these corrections, the stock market recovers and returns to positive territory. In fact, the stock market has produced a positive annual return nearly 75% of the time if we look at over 100 years worth of data. So why is it that we constantly see negative news about the stock market, and why are investors always nervous? There are two major reasons. First, headlines don't get clicked on or go viral on sound economic data. Instead, they receive much more attention on sensational news that are usually negative and short-term. There's a never-ending barrage of bad news. As an institutional investor, it will be important to learn how to tune out the noise and instead focus on the long-term fundamentals, either through the organization's own research or through your investment manager. It is important to find an investment manager that produces consistent communication and insights to help the organization separate signal from noise. The second is that investors' time horizons, both institutional and individuals, also fluctuate. When investors get nervous, again, often fueled by headlines, they tend to take a myopic view, sell the news, and ignore the underlying fundamentals. It is in these times that making a big investment decision is not likely to be optimal. The investors that stay patient and make decisions based on fundamental changes are the ones that are most likely to achieve long-term goals. In conclusion, asset allocation is a critical component of your organization's investment strategy, designed to ensure both financial performance and mission sustainability. By understanding and applying the principles of diversification, time horizon, and liquidity management, you can create a resilient portfolio that adapts to changing needs while maintaining long-term growth. Remember to stay focused on the fundamentals, tune out the short-term noise, and make informed decisions that align with your organization's values and goals.